and I'm broke. If you're a person on planet Earth, then you've most likely heard about crypto. You've probably heard it's been making astronomical gains and it's the future of everything, and also that it's a bubble and it's costing investors huge losses, often all in the same week. Now, I'm not here to argue which side is right, but I am here to see if AI can make some nice crypto money for me. There are literally thousands of trading strategies out there, and quantitative trading is a rich and complex space with physicists, mathematicians, Nobel laureates as primary contributors, and big banks like these hire guys like that by the bucket load to constantly try and beat the market. So I guess that's all there is to it. The market is perfectly efficient, big banks know everything there is to know about it, and I guess I'll see you in the next video. Let's say I have a cryptocurrency like Bitcoin, and it closed today at $100. Now, tomorrow it can either go, let's say, to 120 or to 80. If it goes up, I make a profit, and if it goes down, I make a loss. Now, wouldn't it be nice if I could know exactly on which days the price would go up and on which days the price would go down? Well, it just so happens that predicting what a variable will do in the next period is exactly what machine learning is for. I first want to gather a lot of historical price information on Bitcoin and go day by day and write a 1 if the price increased on that day and a 0 if it decreased, so that I can teach the model what it actually needs to predict in its own computer language. Next, I need to give the model some actual bits of information that it can use to predict what might drive these price increases or decreases. Now, as mentioned, for this video, I do want to keep things simple, so I'll only be feeding the model information on what Bitcoin's prices were in the previous periods, and also what the previous prices were for 3 other competitor cryptocurrencies. Whenever the model predicts that prices will increase the next day, I want to buy, and whenever the model predicts prices will decrease the next day, I want to sell. Let's see if this dirt simple strategy can actually do anything useful. Okay, all done. So as usual, I'll put up all the technical stuff up here and you can pause and have a better read if you want. Now that we have a bot ready, let's see how it actually performed. And it turns out it's actually not super impressive. The model is only 52% accurate at deciding if the price will go up or down on any given day, which is very close to random guessing. How close? Well, I coded a dummy model that predicts prices will go up or down randomly using the historical frequencies of those price changes, and that model is 50% accurate. But remember, the market is insanely efficient, so if you can actually predict what prices will do 2% better than everyone else reliably and consistently, that could actually turn out to be quite a good return for you. The question obviously is, how reliable is that 2% lead in our case? We'll actually run some simulations and check how much money we would have made had we actually invested in this strategy. This process is called backtesting. Okay, so let's start by checking performance on the last 8 months. I'll run the code and it will show me a graph of how 100 hypothetical dollars invested 8 months ago would have performed today. It will also show me the performance of $100 invested in Bitcoin and held all the way through, so we can compare them. Okay, so here's what I found. Investing $100 in my strategy 8 months ago would have left me with $97, so a $3 loss. That's not so hot, but it's not bad when you consider Bitcoin actually lost $9. That adds up to a loss of just 2.7% for my strategy, but 8.9% for Bitcoin, so almost a 3-fold improvement. Not bad at all for a first try. Total returns though can be deceiving because it depends on when you started and ended the test. So instead, let's look at what happened along the way. The average return on any given day was 0.039% for Bitcoin and 0.04% for my strategy. So a small edge for my strategy, although even the smallest of increments here can accumulate exponentially over time. Now, throughout this first test, the model was just 51% accurate, and yet that was enough to beat Bitcoin even after trading fees. By comparison, a random guessing model trained on past frequencies of price movements would have only been 49% accurate, and this is what its returns would have looked like if we plucked them alongside Bitcoin and our strategy. The random model manages to lose a whopping 64 of our original $100. That is brutal. You might be wondering why a random model is doing so badly. After all, it should at the very least kind of stay constant, but while that's not totally true to begin with, the main issue here is we included trading fees into the simulation. So every time the random model or the machine learning model make a buy or sell recommendation, which is every few days, we pay a steep trading cost on par with current spreads and fees from major crypto brokers. But hang on, it's not over yet. 8 months is a really short time in the financial world, so let's go further. My machine learning model still needs tons of data to actually train, so I can't go too far back, but we can do a year and a half. Let's run that now. Okay, so this time around, the strategy model managed to rake in a really nice $234, but Bitcoin completely overshadows that with $593 in takings. We still beat a random model, which again managed to lose money, but what happened here? The new machine learning model from this chart was actually 52% accurate at predicting price increases or decreases, which is more than the first model I showed you. The random guessing model was still stuck at 49%, which makes sense because its returns are a lot lower than our models. But why did Bitcoin outperform both if our model is a whole 3% better than random, and thus 3% better than the market if we assume perfect efficiency? Well, a few reasons. First, there's no trading fees to the Bitcoin chart. You just buy it once at the beginning and sell it once at the end, whereas we have to constantly buy and sell to stay on top of our trading strategy rules. But there's another bigger reason. We can think of Bitcoin itself as a model that always predicts prices will increase and thus always buys. If prices go up and down with equal frequency, then this model will be just 50% accurate. But it turns out in that year and a half from the graph I showed you, predicting that the price will increase the next day every day would have been 55% accurate because price increases were more frequent than price decreases. Now, obviously there's no way of knowing that ahead of time. If we could know that a stock is more likely to go up than go down ahead of time, we wouldn't even need a model in the first place. And that's why even our random guessing model ended up performing kind of poorly. But it's important to always know what your true benchmark is when you're deciding if a strategy or a model works. At this point though, you might be wondering, how is it that a state-of-the-art neural network that takes in tons of historical information on price movements and returns and volumes and volatility still kind of struggles to even beat a random guesser, let alone beat Bitcoin itself? I could talk at length about this topic, and I will. Okay, so here's the thing. The simple reality is that the stock market, for the most part, is incredibly efficient. Now, efficient here doesn't mean that it's an accurate representation of reality. In fact, far from it in most cases, but it does mean that prices constantly reflect all available information in the market. There are plenty of books that have done a great job at explaining this and why it's futile to try and beat the market, especially if you're not a big bank, so I'm not going to dwell too much on it. But I do want you to take a look at something here. What do you think this is? No, it's not a sound wave from my Spotify playlist. It's in fact the daily returns of Bitcoin over the last 3 years. If they seem random, it's because they actually are. Most returns in the stock market are stationary, which means that they don't have a trend, and they also mean reverting, which means they go back to their baseline. This is different from prices. Prices do have a trend, but returns themselves day to day don't. That means even though you can take a general view and say the stock market prices tend to go up or tend to go down, it's really hard to guess exactly when they will go up and when they will go down. So if you want my 3 cents, here's the only 3 real ways that you can consistently beat the market. Number 1 is luck. Even if there's only a 0.001% chance of beating the market, if 100,000 people tried, 1 person would succeed. And there's a lot more than 100,000 trying. Number 2 is having some legal access to semi-private information. So for instance, things like having a data provider that sits behind a $20,000 paywall, or coming up with some new unique mathematical framework that no one understands and no one knows and can help you make sense of how stocks move. Number 3, get a PhD in particle physics and join Renaissance Tech, then build models so complex they could solve world hunger, but instead use them to exploit arbitrage opportunities in intrasecond high frequency trading. As an honorable mention, other ways to beat the market are investing in risk factors, which have been documented academically to carry a premium over the market, or invest in strategies that leverage human psychology and human behavior as opposed to trying to predict through fundamentals or modeling what a stock might do. Okay, so this video is way too long already, so I'm going to skip my usual outro. You know what to do. Like, subscribe, and stay tuned for more.